For more about bank earnings, we are joined by Thomas Hayes, founder, chairman, and managing member of Great Hill Capital. Good to see you, Thomas.
Likewise.
Simple question. Is it time to buy bank stocks?
Well, you get right to the point, Bill. Thanks for having me on. I do think there's an opportunity in bank stocks, particularly if we like to buy the highest value. I think you can find that in Citi and in Wells Fargo. They're both trading at below book. And historically, if you buy large money center banks below book, you make money over time. We like to set up there. I think the theme here, Phil, and John covered quite a bit of it, was that it was a terrible investment banking environment in Q2, and it was a tremendous trading environment in Q2. So a lot of what they lost in investment banking, they were able to make up in trading due to the volatility. And I think that you could see a rebound in that investment banking business towards the back half of the year. All that it would take is a rebound in the equity market, and given the commentary from Bank of America talking about the health of the consumer, the highest quarter ever for consumer spending, up 12% year on year. People are shifting from retail and stores to experiences and, unfortunately, energy and fuel, but also travel. And even Jamie Dimon, who had predicted an economic hurricane, said that the consumer and corporate balance sheets are in great shape, and he sees no cracks in the foundation yet.
Right. I was going to ask you about the comments from Jamie Dimon on Chase. You know, that made a lot of headlines around Wall Street, because what he's insinuating is that there's some sort of crisis that's coming, whether it's with car loans or home loans or something to do with the health of the consumer. Have we relieved those concerns this week?
Yeah, I think what you saw during the pandemic was kind of reliquefying corporate balance sheets. They were able to borrow money for virtually free and buy back a lot of stock, but also rebuild the balance sheets. And the consumers, they got a lot of stimulus checks. Their balances have gone up tremendously. They're still in good shape, but we are seeing a little bit more draw on credit cards. Okay, so those are accelerating. So spending has gone up, even though incomes are not going up quite as much as they did during the pandemic with all the extra stimulus. So that is a near-term risk, and the banks each had to, across the board, Wells, Bank of America, Goldman Sachs, JP Morgan, they each put aside about $500 million for credit reserves moving forward to be on the cautious side. And I think the market's looking at that and saying, okay, responsible, but probably not terribly problematic at this particular moment.
What does it say about the housing market? Because we've seen the 30-year fixed rate go from, the mid twos all the way to the mid fives. I get some places a little higher or lower, but the bottom line is we are seeing a drop off in demand for at least origination of loans for homes.
Yeah, I think what you still have, Phil, is a case where there's not enough supply. You have 72 million millennials, average age 31, starting housing formation, and there's just no supply. I think the big wins, believe it or not, are going to be the lower end home builders that can build the smaller houses, 1,000 to 2,000 square foot starter homes, because the mega mansions that all the boomers have are simply too big for what they need to start out. So that's probably not an opportunity just yet, but I think in coming months, as pessimism really builds on the housing sector, picking up some of those at bargains. I mean, many of those stocks are trading at single-digit earnings multiple, 3, 4, 5, 6, 7 times next year's earnings. So the other thing to keep in mind, the last time we got a 75 basis point hike was December 1994. By July 1995, they were actually cutting rates. And you could see a similar situation playing out over the next six to 9 months.
So, I mean, you're painting a very bullish picture, so that's fine. And if I'm going to close my eyes and buy 3 bank stocks, which 3 are we buying?
On the banks, I'd buy Bank of America, Wells Fargo, and Citibank. I don't really want to be in the businesses that are dependent on a recovery in investment banking, because I can't predict the volatility 1, 2, 3 quarters out, and it's non-recurring income. I like the regularly recurring income, as you saw from Bank of America. Their net interest income and their net interest margin grew. Their loan growth grew. They're solid businesses, and they're trading at steeper discounts.
We spend an awful lot of time talking about inflation, both here in the U.S. and, of course, in Europe as well. And I've always wondered, what kind of impact does that ultimately have on the banking system in the U.S.? Is it a plus or a negative?
It's the same thing with earnings. In the short term, as long as it's contained, it's a plus. That can be passed through. If it persists, then it can be problematic. But I do want to point out one key stat, the University of Michigan Consumer Sentiment that came on Friday, came off the lows. The last print was 50. This print was 51.1. It's been below 58 3 times since 1980. All 3 times marked the peak in inflation and the lows in sentiment, which we may have seen last month. Within 12 months, on average, the S&P was up 20.87% from those inflection points. So what you're looking at is commodities have completely rolled over in the month of June. Unfortunately, you're not going to see that effect at the cash register as a consumer for a few months because it works on a lag basis. As those prices start to come down, we've already seen inflation expectations start to come down, which is what the Fed watches. We may see in very short order the Fed can pause or pivot, and that's when you'll know the bottom is in for the equity market.
Which of course for investors like us, it's basically too late. 20 seconds. Anything in the numbers coming out in the next couple of weeks on the economy that you're keeping your eye on or might change your bullish stance?
Yeah, I just want to see that commodities remain subdued. I also want to see big tech guidance moving forward. I mean, everyone's expecting a little bit of weakness in the ad spend for the Googles and the Metas of the world, but they may have priced in a lot of that bad news that's coming. We want to see how they're seeing things moving forward. And if those big tech earnings can be less bad than feared, this market could really rip because most people are positioned for more downside. And if we, in fact, do get better than expected news, there will be a lot of institutional chasing to meet benchmarks into year end. So we'll take it as it comes on a week-by-week earnings basis, but those big tech earnings in coming weeks are going to be critical. And then the GDP report at the end of the month is also key because Atlanta GDP now shows that Q2 was negative. If that's the case, we may have already had the technical recession in Q1 and Q2 negative GDP. In which case the Fed will have further cover if they want to pause or pivot towards the fall, which would be a positive thing for equities.
Thomas Hayes, putting the pressure on your competitors there in terms of performance and sticking to your bullish stance. Good to see you, my friend. We'll have you back soon.
Appreciate it, Phil.
In a